Investors, we are just a week shy of Santa coming to town.
Santa's coming to town!
Santa! Oh my God!
And with Hanukkah already upon us, today's video is a special one. But before I get to breaking down what I have in store for everyone, my name is Ari, and if you are brand new here, this channel is all about value and dividend investing, whereas you get to see my personal financial journey, listen to me and my macroeconomic thoughts, and then get stock recs as we go, which is exactly what today's video is going to be all about, and of course, with a special holiday spin. Now, before we get going, tap on that thumbs up button for me, and if you haven't already done so, tap on that subscribe button to join me on this journey. With all of that said, let's get right to it. So as mentioned, the holidays are here, 'tis the season, and the thought of gift giving is in mind. Now, I wanted to take a bit of a different approach in today's video in sharing that the dividend stocks I'm going to be breaking down were primarily selected based off the fact that we all should be thinking about where we're shopping, what we're buying, and instead of actually shopping there or buying those very products, maybe we should first think of investing directly into the companies themselves. So in doing so, especially with dividend stocks, well, it's truly just the gift that's going to keep on giving to, well, ourselves as investors. Now, before we break down the dividend stocks, just a quick update on my personal portfolio. My account remains above $100,000 at $100,562.70, despite all the recent volatility from the news that came about this past week, which I'm going to briefly talk about because it's setting us up for the year's end and then the first few months into 2023. So we had the CPI report, or the Consumer Price Index report, come out on Tuesday of last week. This report gives us our inflationary reading, and we saw another month worth of deflation, with inflation coming in at 7.1%, which is great news, and the markets reacted accordingly by rallying. Now, the Dow in the pre-market soared over 700 points, but by the day's end, investors braced for a hawkish Federal Reserve, and we lost just about all of that momentum. The following day, we had the Federal Reserve deliver their next interest rate hike, and it was the expected 50 basis point rate hike that was, for the large part, already baked into the market. Now, the news of both lower inflation and that interest rate hike didn't do so much for us as investors, because Jerome Powell ultimately then provided us with what to expect in the coming months, which is really just more of the same. A Federal Reserve that's going to continue to fight inflation and raise rates accordingly. Now, it was also stated that the benchmark interest rate will likely reach 5 to 5.1% and remain elevated until inflation really is just halved and more, which keeps businesses from really growing and flourishing, hence why the market is exactly as it is. But listen up, if anything, we investors must be using all of these days in a bear market, building up our portfolios to take full advantage of discounted quality stocks, so we're in even better shape come an economic turnaround and entry into a bull market. Now, in addition, everyone from Janet Yellen, our Treasury Secretary, to big-time CEOs are all talking about a recession in 2023, but in knowing it is even better to have time in the market than trying to time the market itself, here we are, or rather, here I am sharing that we should be preparing now with value in dividend stocks, which brings us to our very first dividend stock of the day, one of the most, if not the most reputable sportswear brands in the game. We're talking about Nike, ticker symbol NKE. Now, in the midst of all of the consumer spending habit shifts given recessionary fears leading to consumers looking to penny pinch or just cut out spending entirely when it comes to more luxury goods, Nike has certainly been under pressure, especially with their inventories that may continue to pile up over the next coming months. We can see that their share price has plummeted by over 31% year to date, whereas it was once trading for around $164 per share, now only trading for around $111 per share. That's just about the price of a pair of Nikes themselves. So there you have it. Take your pick, new shoes or ownership in this industry-leading shoe dog. I, however, say that this PE ratio is a tad high as we speak, coming in at 32, but on the other hand, it hasn't stopped smart money from doubling down on the position, which I would equate to a couple of factors, from high sales expectations from the holidays and even just into the longer term recognition that investing is all about finding companies with phenomenal leadership, strong brand names, and healthy balance sheets, to which Nike does exactly all of that. Now, before I get to what analysts are forecasting, you have to take a look at Nike's website traffic because they're actually up 41% from the same period last year. And in knowing that the consumer is supposedly less capitalized at this point in time since then, that is a very promising sign for Nike's long term, which is why we see analysts that are optimistic about Nike's stock share price with nearly 4% worth of upside to come, resulting in a share price of $115.64 per share. And of course, no matter what, we here as dividend investors will cross that finish line on a quarterly basis with Nike's dividend coming in at a dividend yield of 1.09%. Next up, we can either be buying one sleek new phone or laptop for the holidays, or how about we double down on a dividend stock like Apple, ticker symbol AAPL, which I know what many of you are already thinking. This is the world's most valuable company according to their market capitalization of roughly $2.28 trillion. So say no more, my friends. But there is a lot to say right now, which is worth sharing. For starters, let me tell you, the real discount when it comes to Apple is found within their stock, given their share price is down over 20% on the year, trading for just $143 per share. And while I'm always wishing Apple's PE would nosedive, it just isn't going to happen with such a high quality company like Apple. So I'm going to take the PE at its current ratio of 23.8, given what Apple has coming down the pipe, aside from their iPhones and MacBooks, which, by the way, still has plenty of buyers out there flocking to Apple's website. We can see over 56% of an increase from this same period last year regarding website traffic. But we also could be looking forward to Apple's VR headset, which will be hitting the market in 2023. And even more exciting news, we are getting closer and closer to Apple Car, which I really do believe will be an EV game changer. I mean, just imagine your phone, your watch, and all of your electronics paired with your car. Apple also just partnered with Taiwan Semiconductor to get homemade US chips, which I could foresee now many other tech companies out there following suit. But we're here for Apple, so let's see what smart money is up to. And it's no surprise that we see smart money is already ahead of us in the game when it comes to scoring more shares worth of Apple for the year ahead. As for analysts, we foresee Apple's share price climbing to $180.26 per share, which is over 25% worth of upside. Now, until then, we will also be taking full advantage of Apple's dividend, coming in at a dividend yield of 0.63%. As for our third dividend stock today, let's break down the 7th largest retailer in the United States, Target, ticker symbol TGT, which has not fared too well on the year thus far, down just over 32%, trading for $152.51 per share, which is really interesting considering one of Target's greatest competitors, Walmart, has actually been performing quite well. So what gives? Well, with a consumer truly seeking steep discounts to save as much as they can, let's just be honest, Walmart is known to deliver through on those everyday savings. And although in my opinion, Walmart doesn't ever provide as clean or as quality of a shopping experience, this is about getting what I need for as cheap as I possibly can get it. And Walmart is honestly where I would turn to, but it's not as cheap as I would like it to be. So with a PE ratio of 20.7, this is where Target comes in, and it's an inevitable turnaround in this economy. I do believe this is an opportunity for us to be long on this $70.2 billion market capitalized retailer. Now, of course, I am not the only one thinking like this. We see plenty of hedge funds scooping up Target as well for an eventual rebound, as well as analysts that are also forecasting upside over 14% worth of it, with a share price coming up to $175.06 per share. And until we see Target's rebound, we can certainly just rely on Target's dividend coming in at a 2.64% dividend yield. Now, allow this next mention of a home improvement retailer be a suggestion for the 1.6% of my following out there, the ladies. Get yourself to Lowe's to gift your man with a power tool or two. Lowe's, ticker symbol LOW, is not only going to be a great retailer to provide you with gifts this holiday season, but one heck of an investment, given it is down on the year by 15.44%, trading for roughly $212 per share, with a PE ratio coming in at 20.7. But as you know, value is what you get, never what you pay, and I think Lowe's is certainly an investment of value that will continue to deliver through to its shareholders with time. After all, it has been leveled naturally from our economic conditions recommendations that call for consumers to rethink their DIY project plans and home buyers that are just waiting until mortgage rates look a little bit better. And while Lowe's is certainly not seeing the revenues nor the traffic they were at this time last year, Lowe's has experienced a recent spike in website traffic, which is in fact a healthy sign for their future. Not to mention, if we remain forward thinking as we should, smart money has been all over Lowe's as they continue to scoop up more shares of this home improvement leader. As for analysts, it looks like they're predicting 11.8% worth of upside, with Lowe's coming up to a share price of $237.13 per share. And given I am telling you this investment may take some time, I'm here to also tell you that it's worth it, with Lowe's shelling out a nice dividend coming in at a 1.8% dividend yield. Finally, let's talk about VF Corporation, ticker symbol VFC, which is a global apparel and footwear company that has delivered 13 highly reputable brands since their founding in 1899. We're talking about brands like Vans and the North Face to Supreme and Timberland. Now, you tell me, do you think these brands are disappearing or going out of style anytime soon? No, neither do I, especially with a sizable market cap over $10.9 billion. So when I see their share price down on the year by 60% with a share price of $28.04, I mean, this is essentially a steal of a deal you would find at TJ Maxx or an outlet center, the discount rack of all discount racks. And why is VF Corporation down by 60%? Again, it all comes down to consumers keeping to what they need, but check this out. Their website traffic up over 141% from this time period last year. And not only that, but we have hedge funds that are building up positions with VF Corporation as we speak. And I would like to imagine that they're going to be taking advantage of both the rebound and that dividend, which I'm going to get to in a hot second, because I'm going to openly share with you that VF Corporation's PE ratio is a tad high here at 26.4. We are also seeing that insiders of VF Corporation are making informative buys here as recent as 2 to 7 days ago. Now, when it comes to analysts, they are also optimistic about VF Corporation coming to a share price of $31.94 per share, which is about 13.91% worth of upside. And what a sweet buy and hold with VF Corporation, because their dividend is coming in at a dividend yield of 7.1%. Now, investors, there you have it. From Nike to Apple and Target to Lowe's and VF Corporation, the 5 dividend stocks to add to your holiday stock watch list. And perhaps think about buying, instead of buying their products or shopping there, reward yourself even more by just buying the company's stock. Now, I'd love to know your thoughts about any or all of these dividend stocks by dropping those comments down below. Keep in mind that I'm not a financial advisor, so just do all of your due diligence following my videos. What you certainly can do for me is, of course, tap on that thumbs up button. It helps me out in growing this channel. And most importantly, guys, join me on this very journey by subscribing to the channel if you haven't already. I'd love for each and every one of you to be on this journey with me, especially in the new year. So guys, until the next video, I will see you all there.